Hello everyone, I'm Ted Oakley, Managing Partner here at Oxbow, and as always, my pleasure to bring back Jim Bianco, a real pro in this business and somebody that has a great database, a lot of interesting comments you're going to hear from Jim, and I think you'll see numerous times how to get in touch with their service if you happen to like it. But Jim, want to welcome you today and thanks for coming back with us.
Oh, thanks for having me, Ted.
So there were 3 or 4 areas today that I wanted to just sort of start off with and get you've got great views on them, but I'm going to go forward with inflation first. How do you see it?
You know, I guess the fancy word that I would use is persistent, because that's the opposite of the Fed's transitory, that the inflation rate has peaked. It hit 9% over the summer, and it's on its way down, but that's not really that important. What is important is it going all the way back to 2%, which is what it averaged pre-pandemic, allowing the Federal Reserve to cut interest rates and allowing markets to get excited like they were from 2010 to 2019? Or is it going to level off at some level higher than 2%? That's the persistent part of inflation. And then the Fed's aggressive rate hiking campaign is somewhat justified. Now, I'm in the camp that it's going to level off somewhere higher than 2%. And if I had to give you 3 simple, broad rules for why it's going to be higher, is every pandemic produces a change of behavior. And this pandemic is no different. The change of behavior it produced is an attitude change among workers, which we all know from work from home, remote work. Whether we like it or not, for service sector workers, the 5-day work week in the office is over. Now, it may be 4 for some and it may be remote for others, but we're not going to go back to 5. We're going to be at some hybrid type of situation. And I think over many years, we're going to move more towards remote and less towards hybrid. And there's going to be some fits and starts in there. So what that suggests is labor has a lot more bargaining power than management has, and you're seeing that in higher wages. So one of the things that has kept the inflation rate low pre-pandemic was wages were always low. People were just, give me a job, any job. But now, if you see the latest is Disney wants everybody back in the office 4 days a week, and people are walking up and saying, 4 days a week, I quit. And, you know, prior to the pandemic, if you did that, said, I'm going to quit my job because I don't want to go to the office 4 days a week, then we'd have sent you to psychoanalysis at that point. But now that's kind of the way that the world thinks about things today. So the end of cheap labor, higher wage growth is going to keep it up. Currently, wages are growing at 4.5%. They're coming down, but they're still 4.5%. Keep a simple rule of thumb. If wages are growing at 4.5%, if everybody's getting a 4.5% raise every year, you can pay 4.5% inflation, because then your real purchasing power is the same. If you want 2% inflation, you're going to need 2% wage growth, and we don't have anything like that. That's going to be a big persistence part of the inflation. The other big persistence part of inflation is the end of globalization. I think we've seen the words reshoring become a big thing. We're talking about moving fabrication plants for semiconductors to either Arizona or Columbus, Ohio, because of the political stability that the U.S. offers. Of course, it's much more expensive to build them in the United States, that is semiconductors in the United States. We've seen companies like Apple looking to leave China. Why were they in China in the first place? Because they're the cheapest place to be. But the political situation is such they would rather move to Indonesia, Vietnam, or India. Well, why aren't they there now? Because they're a little more expensive. That's why they're not there right now. So globalization may have peaked. It doesn't mean it's going away, but the never-ending line of ever cheaper goods to hold inflation down, they're going to not get very expensive. They're going to get a little more expensive. And that's why I think when you add it all up, we'll probably bottom out 3.5% on the inflation rate. And given the Fed's aggressive stance, it might be appropriate if that's exactly where the inflation rate's going to go.
You know, I was going to ask you on this too. It seems as though, and I'm involved in other companies besides just Oxbow, but all of these companies this year, we came in with cost of living raises. But it seems as though the last 2 years, let's say, that it's sort of gotten in vogue to go ahead and people expecting to get higher wages, higher wages, higher wages. And I'm asking a question here, but once you get that in force or get that moving forward, does it go forward on its own energy? I mean, it keeps on going to a degree.
Yeah, that's what the Fed calls having inflation entrenched, is that there is an expectation that I will get a cost of living increase. You're right. Up until 18 months ago, a lot of people might ask, what is a cost of living increase? Because there was no inflation to really have to worry about, but now there is. And now there is an expectation that if you don't get a raise, that you should start looking for another job. And a great example of that is the Atlanta Federal Reserve breaks down the wage numbers into they break them down in a lot of broad categories, but two interesting ones are, what is your raise you get if you stay at your job? And it's around 4%. What is the raise you get if you switch jobs? And it's around 7%. And that gap between that 3% increase is the highest in the 25 years. They've only been doing this survey for 25 years, but it's a 25-year high. So not only do people expect wage increases, there's a big premium to switching jobs right now. Define your job, go find another job just like yours and say, do you want to hire me? And they'll probably give you a bigger raise than your current job because the unemployment rate's 3.5%. There's a new thing called worker hoarding that a lot of companies are worried that if they let their workers go, that if things turn better, they're going to have to pay up big to get them back. So it's better to just kind of ride along with them now, even though things might not be as great as they should be, in order to not have to pay up in the future to get those workers back. And some, it might be culturally. We want everybody back in the office 4 days a week, and we got a workforce that's content with being in the office 4 days a week. Don't let them go, because the next people we find might only want to be in the office 2 days a week, and that would create a problem. So you've seen this with this entrenchment of wages, that people are expecting wage growth. Now, they're not expecting big numbers, but if they expect 3 or 4%, then we're not going to get wage growth below 3 or 4%. We're not going to get inflation below 3 or 4%.
It's interesting, the companies that I'm involved with and all the employers I know too, they're in this mode where, just like you just mentioned, they will pay longer. Even if business slows down and have good people, they're keeping them around right now. We're not to that point to where they have to let the good ones go, I should say. And that's probably affecting those employment numbers to a degree.
Yeah, the one exception to that might be the tech industry. And because the tech industry has really gone through a wholesale reassessment. It was, the tech industry was, until a year ago, the big growth engine of the world, right? No one cared what the FANG stocks, the Apples, the Amazons, the Googles, the Netflixes of the world were making today. Well, they cared a little bit what they were making today. They were more interested in what would they be making in 5 or 10 years. So the tech industry had this overabundance they had too many workers. Let's just call it what it was. And there was no real urgency for them to cut payroll or cut staff. But then after the wipeout that the tech industries had, people have turned to the tech industry and said, what are you going to make this year? This year? You never cared about this year, over at Amazon. Well, now we do. And so now we're starting to see them start to lay off people. And I might throw in tangentially, I think that from the tech industry and the people I talked to in the tech industry, what happened to Twitter is a big deal too. Depending on the measure you look at, Twitter fired at least 50 to 80% of their staff. And there was this widespread predictions. Twitter would shut down. The app would stop working. It will be a disaster. Now, leaving the politics aside from it, mechanically or technologically, there's nothing wrong with the Twitter app. It continues to work as it's always worked. And there's been some improvements that have come along the way. And they got rid of 80% of their staff. So I'm sure a lot of people are looking around going, hey, Facebook, hey, Google, hey, Amazon, could you fire 80% of your people and still function properly? Maybe you have way too many people. And so when you see all these people getting laid off in the tech industry, don't mistake that for the broader economy. They're kind of unique to everything else.
Yeah, and it's just interesting in that whole Twitter thing. I think the first debt payments come up here pretty soon, on that debt. It's about $1.5 billion or something. But I'm going to move on just a little bit here. I'm going to tie these two together. I mean, you could do this for us. And that is, I'll say this to start with, Jim. I've never seen the obsession that we have right now with trying to get in front of the Fed and figure out what they're doing. I'll tell you what it reminds me of. Back after Solomon Brothers called the bonds in '82, we spent the next 4 or 5 years, every time the money supply came out, they'd run over there every Thursday or whatever day it came out to see what the money supply was doing. It's even worse than that, though. And so it's interesting, the obsession. So I want to see what you think about tying this thing where interest rates, the Fed, all that ties together.
Yeah, there is this obsession about the level of interest rates and this obsession about what the Fed is going to do. And it's almost like your investments are A, will Jay Powell pivot? B, not as important, the collective of everything else. And the pivot means, will he turn around and start cutting interest rates in the second half of the year? The consensus view on Wall Street is summarized as weak first half, stronger second half, meaning that the economy will be weak in the first half of the year. There's a lot of expectations that we might see a recession in the first half of the year. This will cause the Fed to not only stop raising rates, but to start cutting rates before the end of the year. And this will spark a rebound in the economy, lower interest rates in the economy. And then we will see a big rally in risk assets and falling interest rates in the second half of the year. Now that I've said that, typically, if Ted and I have been on Wall Street long enough, when you've explained what the consensus is, you could say, okay, then now that's not what's going to happen. But the trick is what will happen. It's not, what is the opposite of that call? There's lots of different ways it could go. So just saying that that's not going to happen doesn't mean I know what will happen. But I do think that this idea is all predicated on this 2022 was, by some measures, one of the worst years ever. When you look at the collective losses that stocks and bonds together gave you, there's probably no other year, and we've got well over 100 years of data, that collectively you've seen it that bad. And why did it happen? Well, inflation went up, and the Fed Reserve aggressively raised interest rates, and that's the thing that was the main driver for the losses last year. And so you hear a lot of people say, well, the Fed is creating a bunch of poor people by killing the financial markets. So therefore, they've got to stop and they've got to pivot, because without growing financial markets, you're going to really impair the growth of the economy. And if you impair the growth of the economy, people will lose their jobs and everything that flows with that. Well, that's a fine theory, but the only problem with it is that to date, the evidence is very sparse that the economy is slowing. There is some evidence, housing is in trouble because it's very interest sensitive. And yes, the housing industry is one that is in trouble. Tech, as I mentioned before, might be struggling. But then when you get beyond those two, the rest of the economy, whether you're talking about manufacturing or you're talking about basic materials or consumer cyclicals or consumer discretionary or energy, which is booming, the collective of the economy seems to be okay. I'm not going to say it's great, but it's okay. Well, if that's the case, then the Federal Reserve, by raising rates, hasn't damaged the economy to the extent that people think they have. The call for a recession might be premature or off base. And if there is no damage to the economy, the Fed could look around and go, well, we raised rates a lot. And the unemployment rate's still under 4%, and people are still getting jobs, and they're still spending at the retailers. So why should we cut rates? We're still worried about inflation. We haven't damaged anything, so why do we need to undo any of this? And I think that that's really the push-pull on Wall Street. Or if I was to summarize it in in two sentences, the Fed is worried about inflation, and all of their interest rate decisions are based on inflation. And they see inflation is too high, and that's why they're being aggressive. Wall Street is worried about growth, and they see all of their decisions about growth. They think we're going to have a recession, and they think we're going to have negative earnings growth, and we're going to have a big slowdown in the economy. So therefore, the Fed's policy should respond to the weakness, the expected weakness in growth. The Fed doesn't see it that way. They see inflation. And second of all, it's really hard, as I pointed out, to say, here's some evidence that the inflation rate is indeed, the growth rate is indeed weakening. I don't think it is. And that could be a real surprise for Wall Street.
Well, you know, in some of your writing, you have talked about how the Wall Street narrative wanted damage early. You've written about this quite a bit. They wanted damage early in the first quarter or two so that everything would get back to normal real quickly. And I thought that was a pretty good point.
Yes, I would always joke around like, damn it, they didn't fire anybody this month and stuff, because what Wall Street wants is evidence that there is a slowdown, that people have lost their jobs. They want to then turn to Jay Powell and go, look at what you did. Stop with the rate hikes. Start cutting rates. Now, maybe we get that. Maybe that does happen when we get to the spring. We see evidence of that, but we haven't seen evidence of that yet. And this whole idea of weak first half, strong second half, we're running out of time. It's late January. In order to get enough weak data for the Fed to change course, you need more than, here's a bad housing number here, or here's a bad Empire, which is New York, state manufacturing measure there. That's not going to do it. You need solid evidence of a lot of data showing a slowdown. Well, if that data doesn't materialize in this next 60 to 90 days, then to say, well, the Fed will be cutting rates by summer will be too aggressive. You're going to have to push that off into the fall or maybe the winter. Last thing I'll mention on this is the yield curve. The yield curve is inverted. Now, that means that short-term interest rates like the 2-year note are higher than long-term interest rates. That's unusual. That's abnormal. What's normal is as interest rates get longer in maturity, they should be higher, sloping upward instead of sloping downward. When the yield curve is inverted, it has always been a signal. Federal Reserve has been too aggressive with their interest rate hikes and that we're going to have a recession. And it's been correctly pointed out that it's 8 for 8. So going back to the 1960s, every time the yield curve inverts, a recession soon follows. And a lot of people have noted that and are worried that a recession is coming because of the inverted yield curve. And that I agree with. But the one caveat I would give you is it could be up to 18 months after the yield curve inverts that you wind up seeing a recession. It doesn't have to be 30 days or 60 days. Now, the yield curve inverted in November. So 18 months later puts you in the spring of 24. So maybe so what the yield curve could be telling us is in early 24, a year from today, we'll finally start seeing that weak data. Wall Street doesn't have the patience to wait a year for the Fed to pivot interest rates. They want them to pivot interest rates right now. And as I said, if really everything is this obsession about rates and which way the Fed is going to go with rates, if the pivot that is cutting to lower rates is a year away, that will not be taken well by Wall Street as we move forward through the rest of 23.
Yeah, and you've spoken about this quite a bit, but the looking at the rate structure, if you take it out longer than people expect, that's what throws the street this year, and it's interesting because I love the way you look at all of this, because so many of the Wall Street people are on the same wavelength here. They think, we want to get it by April. We want lowering rates so we can get this thing going again. But it just doesn't look like it'll work out that way.
Yeah, exactly. I know. And the mistake I think that Wall Street sometimes makes is they forecast what they want and not necessarily what will happen. And in this case, I'll give a little support to Chairman Powell, and I'll use my words to explain what he's been trying to say. 40% of the country has less than $1,000 of savings, and they rent, so they don't own a home and they don't have a stock portfolio. So if they're getting a 4 or 5% increase at their job and inflation is running at 6, 7, or 8%, every day now, today, when they go to the store, they buy 98 cents or 97 cents of what they bought a year ago. They buy less things for the same amount of money. And they've lost purchasing power. And so he's correct. We have to get the inflation rate down. We have to get the inflation rate down. Well, the other 60% of the country owns their home or owns some financial assets. And they're saying, Jay, just deal with a little higher inflation and cut rates and let the market go up, and that will create a wealth effect. Okay, that helps. That's the divide. That will help those 60%. Well, what about the 40%? How do we help them by getting inflation back down to at least equal to their wage increases so that on a real purchasing power, they don't lose ground? And so, maybe he's got the wrong prescription. Some people have said rate hikes is not the way to go about doing it. And I understand that argument. I don't agree with it, but I understand that argument. But he's got the right idea. We have to get the inflation rate down below wage growth. That has to be first. Now, his prescription for that is we need to reduce demand for stuff. And the fastest way to reduce demand for stuff is to create a reverse wealth effect. You and me and everybody watching this podcast own stocks. We feel lousy because we've lost money in the market in the last year. And we spend less. And so that helps to soften demand and bring things down. I don't like it any more than anybody else likes it, but that's the trade-off that the Federal Reserve has made. And that is and so this gets back to Wall Street forecast what they want, not what is happening. I don't like it. Wall Street doesn't like it. So just because we don't like it doesn't mean that we're going to forecast the Fed's going to stop doing it because we don't like it. Means that they are. This is the path that Jay Powell has clearly delineated. He, I think, is correct that he's got to do something for those 40% by bringing inflation down to at least wage growth. Yeah, we could debate whether he's got the right prescription for it, but to ignore it, raise the target of inflation to 3% and be done with it, which is some have been arguing. That's not going to help those 40% by doing that.
And it's interesting because the same thing you're talking about is what happened to those 10 years prior to 22, which created all this inequality anyway in the beginning. And one of the things that you talk about, you write about a lot, which I really love this line, is, yes, I believe in reversion to the mean on these things, but what mean? Which one are you looking at? I like that.
Right. Yes. So Wall Street, I like to say that reversion to the mean, which means that if a market goes too far one way, it'll come back the other way. Revert to some kind of average. If it's above average, it'll go below average to revert to the average, is a powerful drug because it's correct that markets tend to do that. But what average are we reverting to? And the reason I said that was in beginning of the year, some people said, look, 2022 was the worst year ever collectively for stocks and bonds. So therefore, 2023 must be a better year. So they're arguing that the reversion of the mean is some kind of calendar thing, that because one year was bad, the next year was good. Doesn't always work that way. And I might add, if you go back to 2021, you would look at the bond market in 2021 and you would have said, what was the returns in the bond market in 21? Bad. They were very bad. So therefore, 22 had to be a better year, right? Reversion to the mean? No, it turned out to be the worst year ever. And so you could use that. Well, now 23's got to be better because you had 2 bad years in a row. Maybe, but we don't know what mean we're reverting to. So I get the idea of mean reversion, but it's not as simple as just looking at calendar years and saying, after you've had a bad year, you have a good year. After you've had a good year, you have a bad year, and so on and so forth. It's a little more complicated than that.
And moving on with that subject there, we're talking about Wall Street, but the whole thing now is, and I was going to try to get to this with you, talking about what people are thinking. We have this idea that people are thinking that, hey, I've been damaged, but I'm not going to do anything because it's going to turn any time now. And so in a way, they haven't been hurt enough to actually capitulate or liquidate or whatever. But how do you see the effects of all of this on the bond market and particularly the stock market? Because I think people are having interest in wanting to know, hey, what's happening here?
Yeah, it's from 2008 to 2021, I sometimes joke that the strategy that worked the best for investors was you bought a broad-based basket of stocks like the S&P 500 ETF and just whined and complained to the Fed to cut rates and print money faster to help push the market up. And that's largely what happened. And whenever the market wobbled, like it did in 2016, like it certainly did in the spring of 2020, here comes the Fed with everything but the kitchen sink to make the market stop going down. Now, we got comfortable with that idea for 14 years that was the way the world works. In 22, the Fed, I think, changed their course, and they said that they're going to change and they're going to start focusing on inflation. But investors haven't quite gotten their head around this yet, that they still believe that Jay won't let me go poor. Jay won't let the market crumble. And we can argue what crumble is. We were down 25% at the low in October. We're still down 17-ish% or so off the low with the S&P 500 as we speak. And so if that was the case, I don't think it is anymore. I think that the Fed is no longer in the business of supporting the markets like they used to. And this is why you've seen some unusual investing patterns in 2022 take the bond market. If you look at the flows into all fixed income related ETFs, there was a big inflow during the year. Well, it was the worst year ever. And people just kept buying right into the worst year ever. And so they got killed. And one of the arguments is, well, the Fed can't let me lose this much money. The Fed can't let these markets go down. The Fed will be back to that 2007-8 to 2021 mentality that they have to support the market. So there's this general complacency about the decline that you've seen in the market. Oh, it will come back. And mean reversion, as we were talking about a minute ago, that it will come back. Capitulation is usually the way that markets stop going down. What is capitulation? It's what's happening in the crypto market. People give up. People are embarrassed. They walk away from it, vowing never to play in that sandbox again. And what that usually means when they do that is all the selling is over with. Whoever was going to sell, sold. And that market then can bottom and could come back up. You don't see that in the traditional markets like stock, especially in the stock market yet. That kind of, I'm embarrassed to be called a stock investor. I'm embarrassed that I bought an ETF. Maybe if you were playing in some of the racier stuff like the ARK Innovation Fund, you might see some evidence of a capitulation that I'm embarrassed that I bought it. Well, of course, if you bought it at 116, it's at 35. You're not very happy that you bought it. But beyond that, and maybe some of the stocks that are so affiliated with that, being the big one being Tesla, being down around 60 or 70%, there isn't much in the way of capitulation in the market. And that's kind of worrisome. And it's worrisome because what that suggests is that the other shoe to drop hasn't dropped yet, and that it still may be coming, in the near future.
Let me ask you a question on that. Your opinion, this is at least my opinion, is that we've had a generation or a generation and a half that have only known financial investing. That's it. They don't know anything about anything else. They came into this marketplace, they plug and play. And I think most of those people are, and I've run the numbers on this, there's about 42 to 44% of the people in the industry are less than, say, 39 or 40 years old. And so what it seems to us is that they do not know how to traverse this stuff. You have any thoughts on that?
Yeah, I got one big one, and that is, this is, from 2007 to 2021, the art of picking stocks kind of was an irrelevant art form. I called it a dead art form at the time because, as you saw, you just buy ETFs go up. Something like 90% of stock managers underperformed the overall market or underperformed a broad-based ETF. You didn't have to discriminate between companies. I think going forward, in this new environment of persistent inflation and growth being a little bit more questionable, not necessarily bad, but more cyclical with growth. Here we are 2+ years after the last recession ended, not 8 or 10, and we're talking about another recession. I think that picking companies is going to come back into vogue. So it isn't going to be enough to say, I'm bullish on the energy sector because I think that it's going to go up. I will buy XLE, which is the Select Spider Energy Index. No, you got to figure out which energy companies, individual companies, are going to perform better, because not all of them will be winners within that. That's stock picking. That is the original purpose of capitalism, is to reward winners and to avoid losers. But in the last 15 years, it was everybody got rewarded. If I can only get part of the index, my company can ride the wave with everybody else's company, whether or not I deserve to or not. And I think we're going to go back to a stock picking world. Now that I've said that, I say that to my friends on Wall Street. I go, yeah, I agree with you. I said, yeah, but here's the problem. There's very few stock pickers left. There's a lot of young people under 40 that are very good at picking sectors, that are very good at this macro kind of idea. Yeah, energy is going to go up by XLE. Well, should I buy Exxon or should I buy Total? Well, just buy the XLE because they're both in it or something like that. No, it's not. It's not going to be that simple going forward. I think it's going to be more like the Peter Lynch era of the 80s and 90s, where individual companies matter more. Now, I think that's as we move forward from today forward, and there's going to be an adjustment process in that period too, as we start to realize that there is, to use the Wall Street term, alpha, extra gains to be made by picking stocks. We were all believing to this day, no, there is no point in picking stocks. You can't beat the index. Well, that's been the last 15 or 20 years. And that's been the money printing era and the low inflation era. The money printing and low inflation eras, if they're over with, might look more like the 80s and 90s. And during that period, stock picking did do a much better job of beating the index than we've seen in the last 15 or 20 years.
It's interesting. I was a really young guy, but between 1977 and 1982, 5.5 years, we had a 25% up and down every year. And if you didn't know anything about what you were buying and when you were buying it, if you had an index during that time, you made nothing. You made zero at the end of 5.5 years. And so I think you could see a little bit of that, where you get into those sorts of things. But listen, I'll give you one more thing before we close out. But if you had to give just a broad stroke advice to if you look out there in the landscape today, people investing, and you had to give just a little bit of a broad stroke advice, what would you say to them?
I think this is a great time to be an investor, but not like 2020 and before. In other words, this is not the period where I want to think it's a great time to be an investor, because I think that the S&P is going to go up, or interest rates are going to go back to zero, and there's going to be this big, let's call it macro wave that pushes the market higher. I think that coming out of the pandemic, with remote work, with the end of globalization, with the change, and the big one I think is going to be more, workers have more rights over, or more bargaining power, let me put it that way, over management, that some companies are going to be well positioned for that environment, others won't. And there will be plenty of opportunities to basically ferret through this and say, here's where we want to be and here's where we don't want to be. And that is a different environment than just get in and just own the broad index and wait for the wave to go up. And I think you're right. I would not be surprised if in a couple of years that you look at the S&P and you'd say, boy, it didn't do much for me, and maybe it returned positive 3 or 4%, and we had positive 3 or 4% inflation, and you'd say, on a real basis, I didn't get anything over the next couple of years. Yeah, but there was some giant themes in there that if you caught those themes correctly, energy being the big one in 2022, if you rode the wave of a bunch of the energy stocks, and there will be more of that, I think it's a good time to be an investor, but it's a very different type of environment than we've been in. It's more like the environment of 30 or 40 years ago. So yes, Jim Cramer likes to say there's always a bull market somewhere, and there is. He's right, but we have to recognize that doesn't mean that everything goes up. That's what we think of as a bull market, that this is going to be a little bit more of the old old line capitalist type of thing. Pick the winners, avoid the losers, and you could do very well in this environment. You remember, you were there. I was there too in the 70s and 80s, especially in the 70s when the markets were meandering sideways. There was a lot of people that did very well during that period because they understood that environment. It wasn't because, well, first of all, we didn't even have a lot of index funds then, that people were just broadly owning the market and losing money. But this is going to be more like that. And it's going to be an adjustment period right now as people start to understand it.
And you know, I'm going to say this, and I know a lot of public company people want to appreciate it, but if you look at the last 30 years, and you're talking about public managements and the average worker, basically what's happened with this press down of interest rates, which has caused this refinancialization, you've had all these upper managements really make out like a bandit and take a lot of money really away from the average worker. And that's what's caused this uproaring, I think, when it all comes back around. And that's what they're going to have to deal with the next, and rightly so, by the way, over the next 5 to 10 years. And so we'll see how it goes. But Jim, I want to thank you for being with us. We have put on this piece a number of times here how to get in touch if somebody wants to use your service, which I would totally recommend to anyone that's watching this. But Jim, as always, I appreciate you coming on, and we hope to see you again soon.
Thank you very much.
Thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.